Financial statements are basically report cards for businesses. There are three main ones. Balance sheet. This shows what a company owns and owes at a specific point in time, like a snapshot. Imagine it's a list of everything the business has and everything it needs to pay for. Income statement. This shows how much money a company made, revenue and spent, the expenses incurred, over a certain period. It shows the company's profit or loss, like how well the business did financially. Cash flow statement. This shows where a company's cash comes from and goes over a period. Cash flow statements are separated into operating, investing, and financing activities. It's like tracking the company's flow of cash in and out. Today, we are going to learn about the balance sheet. To understand a balance sheet, we need to remember one guiding principle, an equation. That is that assets equals the sum of the liabilities and equity. Put simply, assets are everything a company owns or controls that has economic value. Liabilities are the company's debts or what it owes to others. And finally, equity is the money invested by the owners and the company's retained earnings. Assets are typically categorized into two main types: current assets and non-current assets. Current assets are expected to be converted into cash or used up within 1 year or within one operating cycle of the business, whichever is longer. Non-current assets, on the other hand, are assets that are not expected to be converted into cash or used up within 1 year. They represent the company's long-term investments and resources. Monitoring current assets is important for assessing a company's liquidity position and its ability to meet short-term obligations. The composition and trends in current assets help evaluate the short-term financial stability and operational efficiency. Non-current assets play a crucial role in determining the long-term value and earning potential of the business. Investors and analysts closely monitor non-current assets to assess the company's capital investments and growth prospects. Current assets are listed in the order of their liquidity, meaning the most liquid assets appear first. Some current asset entries include cash and cash equivalents, accounts receivable, inventory, prepaid expenses, and short-term investments. Non-current assets include various types of assets such as property, plant, and equipment, accumulated depreciation, intangible assets, long-term investments, and others. Liabilities, just like assets, are of two types: current and non-current. Current liabilities being obligations that are expected to be settled within 1 year or within one operational cycle, whichever is longer. And non-current, on the other hand, are obligations that are going to take more than a year to settle. Accounts payable, short-term loans, accrued expenses, current portion of long-term debt, unearned revenue or deferred revenue, income taxes payable, dividends payable, and customer deposits are some examples. And some examples of non-current liabilities include long-term loans, bonds payable, deferred tax liabilities, long-term lease obligations, pension liabilities. Equity, also known as shareholders' equity or owner's equity, represents the residual interest in the assets of a company after deducting its liabilities. It represents the ownership stake of the shareholders in the company's assets. These three elements form the core of most companies' shareholders' equity section: common stock, retained earnings, and additional paid-in capital. Some additional elements we could also encounter are preferred stock and treasury stock. Here is a hypothetical balance sheet of company XYZ. Now, an important thing to remember is the equation that assets equates to the sum of liabilities and equity. This is important for understanding the process of double entry. This means for every transactions in the balance sheet, there are two entries to be made into the balance sheet, which means every credit has a debit and vice versa. In accounting, a debit entry typically means an increase in an asset account and a decrease in a liability or equity account. So, a debit entry could increase the balance of an asset account, like cash or inventory, or decrease the balance of a liability account, like accounts payable. Let's take a few transaction examples and see what account entries we need to make for Company XYZ's balance sheet. Company XYZ starts its operations by investing $50,000 cash from its owners. What do you think will be the entries? Well, cash in current assets will go up by $50,000 and the common stock in shareholders' equity should go up by $50,000. In debit and credit terms, there is a debit entry of $50,000 to cash account indicating an increase in assets, and a credit entry of $50,000 to common stock indicating an equivalent increase in shareholder equity. Here are a few more examples of transactions and entries in the balance sheet to illustrate the accounting method. With that, we have come to the end of this video. Thank you for watching, and I hope you learned a thing or two about the balance sheet and accounting. We will learn about other financial statements in the future.